So enterprise risk management. So far, what we discuss is that insurance and forward contracts. These are the two tools we discuss in detail. Now we want to discuss the third tool, which is what we call it as a future contracts. So as we mentioned that the forward contracts are tailored contracts. They are uh, designed according to the requirements of the buyer and the seller. But future contracts are the contracts which are readily available on the counter. So over the counter. So same profile as the forward contracts. Future contracts trade publicly on an organized securities exchange and requires an upfront cash payment called margins. So we have to keep the margins with the brokers of these or with the corporations who are dealing with the future contracts. And then we can do. So it's just like you have to keep certain amount of money as a margin, which can be a 10%, which can be a 20%. Sometimes if you are very new to the that buying or selling future contracts. So in that case, you have to keep 100% margin as well. So, but it varies from the credit worthiness of the uh, corporations. So requires an upfront cash payment called margins, small relatives to the value of the contract. So their sizes are very small as compared to the size of a forward contract, which is a large contract and which is according to the requirements. So mark to market on a daily basis. The value of these futures are changing on the daily basis because they are traded publicly on this managed security exchange. So every day the price is changing, and according to that, you have to change your margin requirements like this. Clearinghouse guarantee performance on all contracts. The clearinghouse and the margin requirements virtually eliminate the credit risk. So as I mentioned that a very new with no credit history have to keep the 100% margin. So if there is a 100% margin, then there is no credit risk. And those firms who are very well reputed, so they have to keep the margin rate low. But even then, there is no credit risk because of their reputation. Underlying assets, exchange, quote, the contract size is important when determining the daily gains and losses for the marking to market and delivery month, one price, daily high, daily low, settlement price, change from previous settlement price, open interest rate. So how the change in settlement price times the contract size determine the gain or the loss for the day, and long an increase in the settlement price leads to a gain, and short an increase in the settlement price leads to loss. So these are the ways that through which we can say that whether we are in the long position or in a short position for futures, depending upon the settlement price. Open interest is how many contracts are currently outstanding. This is the meaning. These are the terms we use in future markets like open interest or long or short. So interest is how many contracts are currently outstanding for that open interest. So there is how we can use this futures. This is a financial derivative, right? How we can use this financial derivative in order to protect our future transactions. So the risk reduction capability of future is similar to that of the forward contract. The margin requirements and marking to market requires an upfront cash outflows and liquidity to meet any margin calls that may occur. So margin calls means that when there is a margin is short, so they call the customer and then they say that, okay, you have to fulfill the margin requirement. And that's why these future markets, like a stock market, they are operating and they are going up and down. And when the interest rate increase or decrease, that has an impact on the future markets. The reason is that they have, if the interest rate go down, so they are very free to keep the margins account more, and they can buy the futures more and become active future market. And if the interest rate go up, so they feel that to keep the margin accounts according to the requirement is now expensive. So the future markets will become less active. So future contracts are standardized. So again, this is very different from the forward contracts. Forward contracts are tailored, but these are standardized, fixed quantity, fixed sizes. So the firms may not be able to hedge the exact quantity. So either you have to buy more or less because it's difficult to find out the exact values, quantity, and or delivery dates if desired. And dates are also very standardized. So it's not also very possible to match the dates like forward contracts are. Credit risk is virtually non-existent. Future contracts are available on a wide range of physical assets, debt contracts, currencies, and equity. So these are all the areas in which we can get the future contracts. Cross hedging, that's another term we use in future markets. Hedging an asset with a contract written on a closely related but not identical asset. For example, if we are buying futures of wheat, but we are not able to get it, we do a contract, future contract for rice or for corn. So it's not exactly the same. So hedging an asset with a contract written on closely related but not identical assets. So basic risk. When the cross hedging, the risk that the future prices does not move directly with the cash price of the hedge asset. That's a basic risk if we are doing cross hedging. Now, there comes the swaps. Swaps are long-term agreements between two parties to exchange or swap cash flows at specified times based on a specified relationship. So it's going to be that how we can change one assets with another, cash against the commodity, commodity against the cash, or one currency against the other currency. So that's a one instrument with a specific bonds to with a specific interest rate to another instrument with a different. So swaps are possible in every type of assets exchange. Can be viewed as a series of forward contracts and generally limited to a large credit-worthy institutions or companies. So swaps only do among large corporations among themselves because they know each other and they have a if they have a historical relationships. Types of swaps: interest rate swaps. The net cash flow is exchanged based on interest rate. That's what I said. Currency swaps. Two currencies are swapped based on a specified exchange rate or a foreign versus domestic interest rates. Commodity swaps, fixed quantities of a swapped commodity are exchanged at a fixed time in the future. Credit default swaps, corporate bonds are exchanged for a face value based on the reference entity defaults. So, for example, here we are considering an example in order to explain the interest rate swap. Now, company A can borrow from a bank at 8% fixed or LIBOR plus 1%. Floating. So two rates are available for a company A. One is 8% fixed and the other one is LIBOR plus 1%. Company B, on the other hand, can borrow from a bank at a 9.5% fixed or LIBOR plus 0.5% floating. Now, if you look at it, so which one is getting cheaper? So firm A is getting cheaper at a fixed rate of 8% fixed rate loan, and firm B is getting cheaper with a floating rate, with a variable rate. And the variable rate is LIBOR plus 0.5. So company A prefers floating and company B prefers fixed, but their preferences are different. So company A is interested to borrow in a floating and company B is interested to borrow in a fixed. So how they can swap? They can swap. Because by this way, what is happening? The company A is going to get it the floating at a rate LIBOR plus 0.5, and the company B is going to get it the fixed at a 8%. So by entering into a swap agreement, both A and B are better off than they would be borrowing from the bank, and the swap dealers makes 0.5%. So here is a case like pay LIBOR plus 0.5, receive 8.5. So through swap, because they are getting they are borrowing in a fix and then they give it to the swap dealer and the swap dealer give it to the company B, and by this way ultimately they are going to get it 8.5. So what is the net they have to pay is a LIBOR, and swap dealer is pay 8.5 to company A, and what they are getting they are receiving a LIBOR plus 0.5. And company B is getting a pay 9% and getting continued with the LIBOR plus 0.5, and the net is minus 9%. So swap dealer with respect to B is LIBOR plus zero point 0.5 and pay LIBOR plus zero point 0.5 and receive 9. And the swap dealer's net position is they are paying LIBOR plus 9% and receiving LIBOR plus 9.5%. So the net position, the dealer is getting 0.5, and they are also getting, someone is also getting a benefit of a zero point 0.5. So in this case also that we are doing an interest swap, like we have a company A, company B, swap dealers. So these are debt markets. The debt market is offering 9.5% to company B, and and the company A is getting a prime plus 1% floating, and they use the swap market through dealers and they swap it. So ultimately what is getting the company A is getting prime plus 1% floating from the swap dealer, and the company B is getting 9.5% fixed, and the swap dealer is getting prime plus 1.5% floating from the company B. And so in this way, you know that the company A is borrowing from the bank, gave it to the swap dealers gave it to the company B, and company B is borrowing at this rate, giving it to the swap dealer gives it to the company A. So by this way, you see here that exchange is taking place. So the company A borrows at a prime plus 1% and swap for 9.75 fixed rate. Company B borrows at 9.5 fixed and swap for the prime plus 1.5% float. Then comes the instrument, we call it as an option. Option is a right. It's a right. But not the obligation. So you see that the future contracts and the forward contracts, we have to fulfill. It's a contract. But here we are saying option contracts. We are selling just the option, whether you want to exercise, not to exercise. So the right, but not the obligation to buy or sell an asset for a set price on or before a specified date. This is what we call it as an option contracts or an options market. There are two types of options, call option or a put option. So call option, right to buy the asset. This is what we call it as a call, that you can buy, you can call it a right to buy. And there's a put option, right to sell the asset. You can put it there. So this is what specified exercises or a strike price. So specified expiration date. So these are the specifications, like for an option, like you can buy an option for 3 months, call option that you can buy anytime during that time period with this price. So if you think that you are in money, like the call option is in money, then you can exercise it. Otherwise, you can buy it from the market. Same is the case with the put option. If you think that the put option is higher than the market price, so you sell through put option. Otherwise, if the market price is higher than the put option, then you don't exercise and you sell it in the market. So that's the way it works. Buyers has the right to exercise the option, but the seller is obligated. Now, in this case, the seller is obligated. If buyer is exercising, then you have to fulfill. You cannot deny it. And call options writer is obligated to sell the asset if the option is exercised. Put option writer is obligated to buy the asset if the option is exercised. So in a contract, both parties are responsible to fulfill the contract. But this is such a contract in which one party is obligated to fulfill. The other party has an option, and that's why we are calling it as an option contract. So in a call option, who is obligated to sell the asset? Call option writer is obligated to sell, and in a put option, a writer is obligated to buy. So this is the way that it works. Hedging with options, unlike forward and future options, allow the buyer to hedge their downside risk, but still participate in upside potential. Now, what is the benefit of option as compared to future or the forward? Because if in a forward, and we discussed that it mitigates that you set the price, and if the price goes in your favor, even then you cannot get a benefit from this you have to fulfill your forward contract obligation. But in option, this is one-sided in the sense that if the price goes in your favor, you can enjoy that. You don't need to exercise the option. But if the price goes against you, then you have to exercise it. So unlike forward and future, options allow the buyer to hedge their downside only, but still participate in upside potential. So the buyer pays a premium for this benefit. Uh, so it's just like an insurance that we can. So buying a call, when you buy a call, and the call means that you have an option to purchase, but the seller is bound in it. So if that is the case and the price increase, if the risk profile is, if there is a decrease in price, you can enjoy it. So it's not a negative. The value is not going to go down. But if the price is changing, then you can enjoy the option benefit, right? That's what we call it. A selling call, like if you are seller in the call, your profile is going to be, if the price increase, your profile is going to go down. Same is the case with the put. It's a different, like buying a put. Buying a put means that you have a option to sell, and you only sell if exercise the option if the price go down. Uh, if, but the selling a put is creating a negative impact. So we see this is a risk profile, a weighted risk profile, and this is a hedged risk profile. So what we did, we keep the uh, possible that the put option payoffs and hedge profile. So by this way, it's nullify each other and save it. Then hedging commodity price risk with options. Commodity options are generally future options. Exercise a call. Owner of a call receives a long position in the future contracts plus cash equal to the difference between the exercise price and the future price. Seller of a call receives a short position in the future contract and pays cash equal to the difference between the exercise price and the future price. Uh, Normally in call and put options, the commodities are not delivered or the currencies are not delivered. They are only providing the difference of the price from the market. So exercise a put, owner of the put receives a short position in the future contract plus cash equal to the difference between the future price and the exercise price. And the seller of a put receives a long position in the future contract and pay cash equal to the difference between the future price and the exercise price. Hedging exchange rate with the options may use either future option or a currency or a straight currency options uh, used primarily by corporations that do business overseas. Canadian companies want to hedge against a strengthening dollar, receives fewer dollars when you convert foreign currency back to dollars. So put call, sell call on foreign currency, protected if the value of the foreign currency falls relative to the dollar, and still benefit if the value of the foreign currency increase relative to the dollar. Buying puts is less risky. Can use future options, large OTC markets for interest rate options and caps, floors, and collars. Interest rate caps prevent a foreign floating rate from going above a certain level. Interest rate floor prevent a floating rate from going below a certain level. Sell a put on interest rate. And caller buys a call and sell a put in order to protect with a certain band. Since a buyer buying at both options, call and the put option, and by this way they set a band in which the price can move. So the premium received from selling the put will help offset the cost of buying a call. So this is all what I want to discuss from this chapter, which is hedging interest risk with an option. So I convert this video into a YouTube video and upload it in my YouTube channel. Uh, Probably will add a one or two exercise from this chapter. Right now, this is not possible to do here because with the digital pen, the pen is not whatever I write on the screen with the MS team is not going to be recorded. For that reason, I do exercise separately and upload it as a separate video. So this is all what I want to discuss from this subject up till now. We did 10 different sessions, and during that session, we discussed different types of topics. Next week, you have a final exam, so don't go forget to do that. It is available during the next week to do on your Moodle page. So please do it. If you have any question or a concern, email me or write down below the right below the video as a comment. So I will try to respond it as quickly as possible. I wish you good luck for your exam as well as for your future endeavors. Uh, Thank you. Bye bye.